The lifeblood is, anybody who does financial projections knows cash is the lifeblood of a business.
I tried explaining cash flows, and I just saw
like statement of cash flows or just cash flow?
But it's the statement. Yeah, it's just like there's a difference. There's a difference.
Oh yes.
Like there's this pool buddy over here that we can use. It's different from our net income.
Yeah.
Like, this is nice. This is more.
Yeah.
Where do we find chapter 16 if there's going to be extra credit?
I will get it posted up. I got to put the 10 questions up. The extra credit. I'm going to talk about that today, amongst other things.
We started it about 2 weeks ago. We closed it halfway through. I've had a 40 for like 2 weeks.
Yeah, I was actually doing some statistical analysis on the grades this weekend on some of the early quizzes and on the midterm, and looking at projected grades at the end of the semester, as much to make sure that I take some of the final and I make sure I got it geared right so that it's not too hard. Because what I don't want to do is put a 25-point curve on the final if I don't have to.
It means you don't live for moments like that.
I know. Literal, and I know that there's other instructors that feel differently, but literally when I walked out of the first section of this that I taught, and I had folks that were in the 20s and 30s, I was like, I coach that up.
You should talk to Don about his grading scale. He's got a unique scale.
The unique scale, Don Coleman.
Yes.
Yep, no worries. Okay, so I'm going to get started for the purposes of today's discussion. I want to cover a couple housekeeping items first, and then move into the kind of last phase of what's on the quizzes and tests. So we're going into chapters 14 and 15, which is really 14, 15, 16 are really the application of finance theory to day-to-day operations of your company. And so this is far more. There's a bunch of calculations that you're going to see in the book. There's a bunch of calculations that you're going to see potentially some in the quizzes. You're not going to see them on the final. This is one that you really need to have a far better grasp of the concepts and understand what questions to ask than calculating out stuff like day sales outstanding and total float. We're going to talk through some of those concepts. I took the two quizzes that were due. One was due last Friday, the one that's due this Friday. I pushed them all into late next week so that you've got a little bit more time. I know that there's a number of folks contacted me between the weekend, late last week, and this morning and said, I've got project X, Y, or Z that's due today. I've got this due today. I've got that due next week. Can I get a little bit more time? Or, I took the quiz last week. I got it done, but I was only able to I only had time to take it once, and so I only got an 81, and I want to be able to take it again. So in the interest of humanity and trying to be somewhat humane, I push these things out for a week and a half or so. So you've got a little bit more time. The other two things is I am going to be standing up a quiz for chapter 16. That's extra credit. It'll be extra credit for the final or extra credit elsewhere if you need it. It's going to be worth about a potential of up to 10 points on the final. That's going to be posted out there. You're going to see it due the Friday after the final. So it'll be due the 10th or 11th or whatever day that is. I'm going to post that out in the site, and the Cengage site. The other thing is you do have, and a couple of you have asked questions, yes, there is still 2 potential written projects for extra credit if you feel like you need them. Those 2 potential written projects can be turned in up until the Friday of finals week. So you've got, if you take the final and you're like, that did not feel as warm and fuzzy as I thought I'd want it to, you still have time to slam out those couple projects. You will be receiving, probably on Monday, the information you need from a company perspective to be able to take the final a week later. So I'll be getting that out to you Monday. Additionally, on Monday, you should be getting the lecture for chapter 16, which will be posted out to the website. So, or out to Moodle and out to YouTube. So you're going to have an opportunity to pick up some grades. I did grade out the midterm. I've now loaded that into Moodle. You kind of knew where you were at, or should have known where you were at based upon the fact that you can see your grades on the online system. But I put it out in Moodle, added your extra credit if you had extra credit, so that you've now got a better picture of where you stand as it relates to the midterm. You should know where you stand relative to the quizzes. I did a bunch of analysis this weekend. There's a number of folks that didn't do all the quizzes. You have an opportunity to make up some of that. There's practice quizzes at the end. So as I noted before, if you want to do some practice, you've got practice quizzes at the very end of, I think they're posted on the 28th of May, that you can take to your heart's content. To the extent you take a practice quiz that is a quiz related to one you did not take prior, that will give you some credit, probably 25% or 30% credit for taking the practice quiz. So if you did not take a quiz, you may still go in and take a quiz. And as I've told folks, even if you don't want to put the effort in, for Lord's sake, just put A for every question and get something. Because a 0 will tank your grade far faster than a 25 or 30%, especially when you're looking at, you know, a number of weeks. And so, again, you've got the opportunity to do a little bit of mitigation in the event that you've missed a quiz. And there's quite a few folks that missed one or more. So get back in there and get those taken care of. Finally, there is just a reminder, the final is 10 o'clock in this room, the Tuesday of finals week. The review for the final is Monday night, 5:30 in this room. We'll go through a couple practice problems. We'll go through a few examples. I'll answer any questions you want. We're basically going to run 5:30 to 7, 5:30 to 7:30 in advance of any weekly classes. I think Dr. Conan has this room reserved at 7:50. So if you have any questions, that's a good time to ask. I do have office hours. However, as an FYI, I am out starting Wednesday right after this class for the remainder of the week. I'm up in Seattle at a conference, and so I will not be here Wednesday afternoon, Thursday, or Friday of this week. There is no class this Friday. Take this Friday if you need it to get the Excel spreadsheets put together for working capital management. Well, not for working capital management, excuse me, hold on. So for weighted average cost of capital and for capital budgeting, so that you go into the final with some level of preparedness for those two things. Any questions on all the administrative stuff before I dive into today's discussion? Okay, good. As usual, we've been able to, with one exception, I think in the last week, most of these lectures have been recorded. I know there's a number of folks fighting illness or have been fighting illness over the last couple of weeks. Please get caught up on the lectures as well. So I'm going to dive into chapters 14 and 15, which are the last two chapters that are going to be on the final. They're the last two chapters that are on the final quiz that is due next Friday. And anything that comes from chapter 16, like I said, that's going to be extra credit. That's going to be recorded and posted up next Monday. Quiz for that will be due the Friday after the final. And that'll be extra credit that could be used toward your final exam. Or if you do get 100 or more on your final exam, I will roll those extra credit points over to something else where you need it. So I'm not gonna, yes ma'am.
Has that ever?
What? Yes. Yes, I actually have had 2 students get over 100 on the final because they did the extra credit on the final too. So yes, it's happened. I've had ranges from 22 or 21 up to 106. So, you know, it's possible. If you come in well prepared for the final with your spreadsheets ready to go, you stand a fighting chance of getting 100 on the final. If you don't, you won't, because there's just not enough time. Any other questions? That was a good question. Okay. So let's talk working capital management. Working capital management is the lifeblood of your company. If you guys are out and working on your own, or you're working as part of a company, this is probably the single most important practical thing you can do to keep that company alive. Most of what we've talked about this semester has been a lot of theory around long-term investments. So we're looking at periods of more than a year, where we're going, okay, I'm thinking about buying this piece of equipment, or I'm going to float this stock, or I'm going to buy these bonds, and I'm going to hold them for a multi-year period, and I'm looking for an over-the-top or economic return that's in excess of my economic cost. I'm looking for economic profit. The reality of it is when we get into managing businesses or managing universities or managing not-for-profits, our entire focus in life needs to be on our cash flow. And that's why finance is so cool, because we focus on cash. We don't focus on accounting stuff, which is important as a measurement, but is not the lifeblood of your business. The lifeblood of your business is cash. And the way you manage cash is working capital management. It's essentially the management of your short-term assets and liabilities in such a way that you don't run out of money. Because you can have an incredibly profitable business, but if you run out of money because you're not managing your receivables, or you're not managing your payables, or you don't have adequate capital to deal with the ups and downs of seasonality, you go out of business. And so this is we're going to focus, instead of focusing on a bunch of calculations, which in practice, most of us never use, I'm going to focus on principles and practices that you will use regardless of whether you're in a finance role or not. If you're in business management anywhere, the stuff that we're going to talk about for the next 2 weeks is critical stuff to understand. It's not critical for the final. It's only going to be a small piece of the final. It's a 1 or 2 small quizzes, but it's absolutely critical for the real world. So I'm going to focus a little bit on what's useful for the real world. So working capital management is nothing more than the management of your short-term liabilities and your short-term assets. Because at the end of the day, we generally live as a business paycheck to paycheck, just like most of society lives paycheck to paycheck. And so your ability to manage your bills and your income in the short run is your key to survival, your key to eating, your key to paying your people, your key to being able to make your rent. And so that's a critical component. Net working capital, the accounting definition and the finance definition are essentially the same. It is nothing more than your current assets, the stuff that you have that can be converted to cash in a very short period of time, technically within 1 year from an accounting perspective. But from a finance perspective, we tend to look a lot shorter. We tend to look 30 to 90 days as a practical matter for current assets and current liabilities, which again, from an accounting perspective, is technically under a year, anything that's due or may be due in under a year. And from a finance perspective, we tend to look shorter, again, 30 to 90 days or shorter than that. So we tend to look at a short time period and go, okay, do we have enough cash to keep ourselves alive? And again, the other part that we look at for net working capital is how much of our net working capital, how much of our short-term needs are being financed by long-term liabilities. And so there's a component of this, which when you take money in banking and you start looking, or those of you that are finance geeks and you start looking at banking as a potential career, you'll find that there's risks associated with the timing of our cash flows. And we're going to talk a lot about that as we dig into this, but not from a money and banking perspective. I'll touch on it now, however. One of the challenges that was faced by banks many years ago, which indirectly led to the 2008 financial crisis, but led to the savings and loan crisis back in the 80s, was the fact that banks would lend money short-term, or they would borrow money short-term, They get deposits from you. So they would go, okay, you guys have your savings deposits and you have your checking deposits, and they pay interest on those deposits. And that's a short-term liability to the bank. They would borrow short-term. And then they would make loans, mortgages that they would hold on their books long-term. So what happened in the 70s was mortgage rates were relatively low. You could get 5-6% mortgages. They were loaning out their money, or they were borrowing money, excuse me, I'm getting reversed. They would have savings accounts with loans at, 2, 3, or with interest rates of 2 or 3%. They make money on the spread. Well, when you're borrowing short term and interest rates begin to rise like they did in the late 70s and early 80s, all of a sudden you have to pay more and more money, more and more interest to attract those deposits. So now you're paying 11, 12, 13% interest to get someone to put a certificate of deposit or savings account at your bank. But you're only making 4 or 5% or 6% or 7% on a mortgage that you made 10 years ago sitting on your books, and all of a sudden now you're upside down. You're paying more to get the cash in because you're having to recycle that every 30, 90, 60, 120 for 1 year on your short-term deposits. Your rates start going up, but you're not able to raise the other underlying interest rates on the mortgage. So as a result, what ended up happening was these savings and loans who held the mortgages on their balance sheet lost money. So what banks did was they got smarter, and they said, we're going to do 2 things. One, we're going to securitize. So we're no longer going to hold these mortgages on our books. We're going to create these collateralized mortgage obligations and sell them and get the money back and then rinse and repeat. And 2, we're going to create variable interest rate mortgages. So when interest rates rise and we have to pay more for our deposits, the folks who borrowed money from us then have to pay more on our mortgages. Well, what ended up happening then, of course, was as interest rates began to rise, the mortgage payments go up, or they put teaser rates on, and then the mortgage rates would go up, and folks couldn't afford the mortgage. And so as a result, you had this combination of securitization, which made mortgages easier because the banks didn't hold them on their books. And you had variable rate mortgages, which meant when interest rates rose, it was tougher for people to be able to make the payments. And so you saw the combination of those two lead into the 2008 financial crisis, kind of as an indirect result of the 1980s savings and loan crisis, which was driven by the fact that banks did not do a good job of managing their working capital, their short-term and long-term liabilities, and timing those 2 things out so that the interest rates rose and fell together. You do not want to get stuck in that position as a business owner, and you certainly don't want to get stuck in that position if you're a banker. So you have to develop a working capital policy, a way to manage these things that's going to allow you to not go bankrupt. And so we're going to look at some of those policies. The first one is you should be looking at targeted levels of working capital. How much do you need based upon the way your business operates? You may be a seasonal business. So all of a sudden, you're sitting in the middle of the winter, and I run a construction company at one point in time. And in the winter, you have very few jobs, and you have people that you may or may not want to lay off. So how do you manage your working capital so that you can survive the winter? And then conversely, when you're really booming and you need to be able to pay a bunch of folks and people are making their bill payments late and their progress payments late, how do you then make sure you've got enough capital to be able to survive when it's really busy so that you're able to pay your folks and pay your suppliers while you're waiting for payment to come in from your customers? Seasonality is but one of the components that may drive your working capital policies. It's also how current assets get financed. So when you've got accounts receivable, you can't pay payroll with accounts receivable. You have to pay payroll with cash. So how do you manage things like your collections policy? How do you underpin your accounts receivable or inventory that you're using every day? So you've got to buy a bunch of raw material, which you turn into fixed products, which then are sold to retailers, which then they sell and then pay you back. As we looked at Unilite, we'll look at Unilite again. It took them 120 days for that cash flow cycle to close. Well, how did they finance all that stuff for that 120 days? That's part of your working capital policy. And again, working capital, per the finance definition, is really focusing on short-term assets, short-term liabilities. It's not looking at your long-term liabilities that are used to finance your short-term liabilities. So we're going to talk through a little bit about why you might use, from a conservative perspective, a little bit of long-term debt to give yourself a cushion. But at the end of the day, working capital is kind of right at that edge of, I've got a payment due in 30 days, 60 days, 90 days. I've got cash coming in and going out. How do I manage those two things so that I don't run out of cash before I run out of bills, or vice versa? So the cash conversion cycle is what we need to manage as managers. At the end of the day, the company's lifeblood is its cash. The school's lifeblood is its cash. Your not-for-profit, your church, your food bank, its lifeblood is its cash. And so our job as managers, whether we're in sales, whether we're in product development, whether we're in finance and accounting, whether we're in general management, our job is to get cash in the door. We cannot fulfill our mission as a school if we run out of cash. We cannot fulfill our mission as a church if we run out of cash. We cannot stay open as a business if we run out of cash. Our job ultimately comes down to how do we get cash in the door so that we can do what we intend to do, no matter how altruistic it is. You can't do it without cash. Even you as an individual, as a volunteer somewhere, can't survive without your own personal cash conversion cycle where you're having to work somewhere to get enough to pay yourself so that you can feed yourself so that you can volunteer somewhere. So the cash conversion cycle is nothing more than how long does it take to go from raw material payment through to the sale of the product, the collection of the accounts receivable, and cycle that through. What do you think our objective is? Should this be a short or long-term process? Short, as short as possible. Ideally, you get payments in advance, then you buy your inventory, and then you pay your payables. So you end up, you can, and some businesses have done a good job of going, okay, you pay me first. Dell, for instance, has done a wonderful job of going, order up your computer and pay me. Then they use just-in-time inventory to go buy the inventory. They build your computer and send it to you. So they got paid first, no receivable. Then they got the inventory, shipped the computer in a matter of days, and then they pay the supplier 30 days later. They have reversed the typical cash conversion cycle where they get the money up front. In many cases, if you can figure out how to do that, you're ahead of the game. Your working capital management is really good. Most businesses, however, university being one of them, is kind of in the opposite, where we sit there and go, okay, students come to school. Now you have drop add period, you've got this period, that period. Okay, now we're going to draw down your federal loans. So we go, okay, we're going to draw your federal loans. We have to wait 30, 60 days to draw federal funds. So the university is operating for the first 30 days of a semester on almost no cash. Then we get, in this case, in the university's case, about $13 million of cash show up in, let's say, the 1st of October. Then the next time we get meaningful cash coming in is February. 13 million more in cash comes in. In the meantime, we've got to make payroll. We've got to do all those other things so that we pay our staff, our teachers, our student workers. Once we get that collection in February, we get another tiny little bit in July for summer session. But basically, we have to go from February until the 1st of October with no more cash. So we've got to manage that working capital. That's an extreme example of how university is not only seasonal, but also has a very long cash conversion cycle. And because we're delivering those products before we get paid and after we get paid. Having said that, that's why working capital management becomes important. Because if I get to August, which is my most stressful month of the year, August and September, and I'm running out of cash, I've run out of cash, there's no way to pay professors to come in September and start educating students before we make the next draw of federal funds in October. So we've got to make sure that we manage this closely. If you're running a business, you've got the same piece. How quickly can I convert inventory to sales? How quickly can I collect the sales piece and turn it into cash? And how slowly can I pay somebody else? So this piece is how fast can I, how slow can I? Because this payables deferral generally is a near zero cost. In some cases, people will go, you have to pay us $210 net 30, so you got a discount. You may want to pay them faster because, again, that 2% discount if you pay in 10 days is worth a fairly heavy effective interest rate. Having said that, many companies don't start incurring finance charges until 30, 60, 90 days out. So the longer you can delay, you get to collect money because you've got it invested potentially in a savings account, and you're not paying interest to the people you're borrowing the money from. So as fast as you can, as fast as you can, as slow as you can. And there's calculations behind each one of these, which like I said, we're not going to dive into, but there's calculations to basically optimize that. How slow can I, how fast can I, how fast can I, in order to be able to maximize your profit. The inventory conversion period is the length of time to convert raw materials into finished goods and sell them. And the amount of inventory, or the amount of time a product remains in inventory at various stages of completion. The longer that takes to go from raw material to a sale, the slower your cash shows up. At the end of the day, normally you're putting money out for that inventory and you want to convert it to cash as quickly as possible. This is the calculation to calculate inventory turnover. You're not going to see this calculation too often unless you're in financial analysis and you're looking at a company who's got cash starvation. And so if you're looking at a company or working at a company, and as I kind of told you, my background before I came to the school was turnaround management. So I spent 15 years or so doing this type of work where you walk into a company that's running out of cash and you go, okay, where's the problem? About 2/3 of the time, the problem is in the cash flow cycle, and a lot of it remains in inventory. So how long does it take to convert a piece of raw material into a sale? You want that to be as quick as possible. And you want as little inventory as possible. You can see the inventory number here is a kind of critical component. So if you have something where it's just in time inventory, where you're not bringing the inventory in until you need it, and you're not sitting on piles of inventory, that does two things for you. The first one is it reduces the amount of cash that's just sitting in inventory on your floor, not turning into a sale. What do you think the second most expensive cost of inventory is outside of I've expended cash and it's sitting on the floor waiting to get turned into something? Warehousing and storage, that's number 2. What would be the number 1?
Your discount.
Say again?
Might be your discount when it disappears.
That's normally number 3.
Overhead?
Depends on the business.
Overhead?
What do you mean by overhead?
The amount, people to move it, people to keep track of it, people to, everything around.
Everything around it.
Yeah.
That's, I'll count that in kind of the storage piece and the warehousing piece. So that's normally number 2. What do you think the number 1 cost of inventory is outside of financing it?
Running out of things.
Inventory obsolescence, spoilage.
Oh.
So you run into a situation where you have this inventory, and especially if you're building equipment, all of a sudden you're like, okay, I've got a bunch of inventory associated with car X. We get a new model year, now I've got a bunch of excess inventory. Or I buy a bunch of clothes, and it's clothing inventory, and styles change or seasons change. Or I've got electronics, and there's an upgrade to either RAM, or there's an upgrade to the underlying processor or the video display, which makes that inventory obsolete. That inventory now, instead of having a cost associated with its retention, which tends to be a fraction of the cost of the inventory to store it, to ship it, to manage it, a fraction of the inventory is going to walk out the door because employees are going to steal it. What ends up happening in this particular case is the inventory value goes to 0 or near 0 because you have to scrap it. So inventory, the smaller the amount of inventory you can maintain in your business and still meet customer requirements. And we're going to talk a little bit about that in here, but we're not going to calculate it. You guys have operations management, you'll learn optimal economic order quantities in there. But essentially, you want to maintain the minimum amount of inventory possible. in order for your business to run. Not only operationally, but also from a working capital management perspective, you have less working capital tied up in that inventory. We talked about inventory and working capital tied up in inventory back in capital budgeting. If you remember, one of the initial cash flows in capital budgeting was increase in working capital. And if you recall, increase in working capital, when I was talking about it, I said a lot of times that's inventory. You got to buy new inventory and it's sitting on the floor waiting. And then at the end of the project or the end of the product life, you get that money back. You use up the inventory. During that entire period of time, it's being recorded as a cash outflow in period 0. And it comes back in as a cash inflow at a big discount because you discounted that project all the way out. It comes back as a cash inflow way out in period 4, 5, 6, 10, 15. And so you don't want to tie up, if you think about it from a finance perspective, you don't want to tie up cash flow that you had to pay out today at no discount and get it back at some future point in time on a big discount. So from a finance perspective, it makes sense. You want inventory as low as possible because it's a cash outflow in period 0, a cash inflow at the end of the project or product life. So if you think about it in terms of finance, it makes sense. If you think about it in terms of practical common sense, it makes sense. Stuff sitting around tends to walk, tends to get old, tends to spoil, tends to become obsolete. It costs you money to store it. So you really don't want to have stuff sitting around. The next one is receivables. If inventory in a turnaround situation is number one problem, I've got a bunch of obsolete inventory, I've got a bunch of money tied up in inventory that I haven't converted into cash, and I'm going to blow that out and liquidate it quickly. Receivables become the second, and these two tend to are pretty close on number one, number two. Receivables are what?
The money people owe you.
People owe you money. So you sold something to them, you shipped the product, and they haven't paid you yet. Or you've delivered a service, and they haven't paid you yet. So receivables are nothing more than, I've done the work, I've given you the product, and you haven't paid me yet. Receivables need to be turned into cash. To the extent that receivables sit out there for any length of time, bad things happen. What are those bad things?
People go bankrupt.
People don't pay. The number one thing, by the way, for most of you, when you go out in the real world, people don't pay. As a matter of fact, people don't pay on purpose. And in some cases, they won't pay until you pick up the phone and call them. Like on principle, they won't pay. And then they won't pay the finance. So you go, well, I'm going to charge you interest. I'm going to put finance. They won't pay the finance charge either. They'll pay you the amount they owe you. So if they owe you $10,000 and you charge them $200 in interest, $300 in interest, they'll pay the 10 grand. And they'll basically go, okay, so sue me for the $300. Or I won't put my next 10 grand order in because you're trying to collect the finance charge. Mind you, I've used that same technique myself managing because you want to drag it out as long as possible. That's part 3. But when you're trying to collect,
You're the guy.
yes, I'm the guy. Because you got to get cash. You got to stay alive. So on the receivable side, you want to turn your receivables into cash as quickly as possible. There's a couple ways to do that. The first one, and most likely logical one, is you pick up the phone, you call them and say, get your money in, or I'm not going to ship the next set of products. I'm not going to complete the project. I'm not going to help you with your return. I'm not going to appear in court. I'm not going to do those things that you need to do because you got to pay. Now, some of those things are pushing the envelope of what you can do. Or I'm going to sue you. And the next thing you've got is you've got legal. And the last thing a lot of people use is factoring or financing. So they go, okay, I'm going to sell the receivables to somebody else at a discount, but I'm going to convert them into cash. The faster you can get your receivables turned into cash, the better. The longer they sit out there, the less likely they are to get paid. Once you get over 120 days on a receivable, your chances of getting paid are down dramatically. Once you get over 60 days, they drop dramatically. It's exponential drop off the longer your receivables are out. You should generally be wanting to get paid when? Before. You want, if you're managing a business, you want them to put a deposit down. You want to get cash in the bank up front. You want them to prepay. You want to be like Dell, have no inventory, have them pay you before you order the inventory. You want to get paid and not have receivables. You want to get paid in advance. You want to have prepaids on your books that are sitting as deferred revenue, and you're going, okay, I've been paid for this, it's deferred revenue, I'm not recognizing the revenue yet because I haven't done the work, but I've already got the cash. That's the position you want to be in. The last thing you want to be in is in a position where you've got a significant portion of your accounts receivable sitting out at 60, 90, 120 plus days, because as that continues to age, you're not getting paid. Not only is it costing you money in terms of financing, because again, if you think about it and you say, okay, I put out the money, so you go into finance terms, operating expenses have been incurred in period 1, and you're not getting paid, the cash inflow doesn't come in until period 3, you've got a discount on that cash inflow because it's been out for a period of time, and money has a time value. And so you're sitting there going, okay, I'm waiting for this money. In the meantime, I'm having to finance my operations month after month after month until I get my cash. We'll talk about how to bridge that financing, but at the end of the day, you want to get prepaid on your receivables. So you don't have receivables at all, you have deferred revenue. And if you can't, you want that to be as quick as possible after the sale. So you deliver, I get cash. You extend terms, you want to make sure that those terms are sufficient to be able to justify the extent that you've got enough profit to be able to justify essentially financing your customer for some period of time at 0% interest because you're paying interest on the money. And the last piece is the payables deferral period. The slowest that you can go, the better. So in this particular case, you're on the other side of that equation. So you've got somebody who you're paying. They want cash from you. Normally, they're not paying you, you're not paying any interest on that, just like when you extend credit, when your supplier extends credit to you, they're giving you an interest-free loan normally for some period of time. When you're trying to survive, and cash flow is critically important, what you want to do is make sure that you've got cash coming in and not cash going out as long as possible. You want to use this as interest-free financing. So on the payables deferral period, you're looking at the average length of time between the purchase of raw materials or the purchase of anything and the payment out to the vendor or the payment out to the employee or the payment out to the contractor. And so as a management rule, within reason, you want to extend this as long as you can. If you had a choice between paying in 15 days or in 50 days, which do you choose? 50. Why?
Because the longer you have the money, the more.
Yeah, the longer you have the money and you're not paying interest on it, but in, let's even use a ideal world, you put it in a savings account and you're collecting interest on it, you're ahead. And when you think about in terms of discounted cash flow, if I've got a cash outflow at period 1 or a cash outflow at period 50, the cash outflow at period 1 has a higher net present value negative than the cash outflow at period 50. So if you think in terms of finance, the longer I could delay a cash outflow and still get the same result, the better. And so again, when it comes to payables deferral, you want to defer payables as long as possible. There are ethical considerations around the fact that you refuse to pay, or that you over leverage your situation and are completely irresponsible as far as putting another business in jeopardy. Having said that, take advantage of what is available to you ethically and stretch out your payables to as long as possible. Here at the university, we pay for the bulk of the year. Our payables are mostly at net 30 and the check goes out at day 27. So we pay basically at the 30-day point. In August and September, when I'm running out of cash, we pay net 45. And I slow payables down so that I have enough cash to make payroll. When I draw in all the money in October, I get back to a net 27. So again, that's cash flow management, because when you think about $50 million of expenses, or let's use an easier number, if I think about $36 million of expenses, which is $3 million a month to run the university, if I can extend the payables by 20 days, that gives me $2 million of additional cash, which allows me a little bit of cushion. And so that's how this tends to work, is if I slow stuff down, it builds up a little bit more cash reserve, which allows me to breathe a little easier through the months of September and August when we've waited since February to get the next cash inflow. So the cash conversion cycle is the average length of time a dollar's tied up on current assets. So it's the inventory conversion plus the day sales outstanding minus the payables. And you want that number to be as low as possible. You want this cash conversion cycle, which is measured in terms of days, to be as low as possible, which means you want this to be as low as possible, this to be as low as possible, and this to be as high as possible. It's a relatively straightforward process. And in reality, when you think about your own life, it makes common sense, right? You want to get paid, if you ideally could do it, you'd want to get paid weekly or daily, although that makes cash management maybe a little tougher, but you want to get paid weekly. Here at the university, we pay our employees monthly, once a month. Why do you think we pay you monthly?
The longer you hold on to it, the more interest.
There you go. So we pay monthly at the university, but ideally, if you were an employee, you'd want to be paid daily. And when you get paid, when you get a bill, how many folks pay their bill? Your bill comes in the mail, you immediately sit down, write a check, and send it out. Or you immediately get on online banking, which is how most of us do it, and send out that check. How many of you wait until it's actually due? How many of you don't have any bills? God bless you. Enjoy it now. Enjoy it while you can.
Unless it's collecting high interest, and then I try to pay it.
Yeah, unless they're giving you a reason to pay it earlier, like it's a credit card bill, and if you don't pay it on time or early, you're going to pay 18% interest. Most of us wait until the thing's due. And then, in some cases, if you're like, I've got more month than money, you may go, okay, how many of these can I delay that aren't going to get me into trouble, right? You go, hey, I'm kind of out of cash, so I know these couple, they ain't going to do nothing. There's no interest, so I'm going to wait until I get paid next week. Even though they're due this week, I'm going to wait until they get paid. I'm going to wait to pay them until next week because I got more month than money, and so I'm kind of got to delay those. You're doing the same thing in business. It's the same process. It's the same decision-making process. How many vendors can I delay off because I got more month than money? So I'm at day 30, everything's due, and I can't pay everything. You start picking off the ones that aren't going to charge interest, don't have, they're not critical vendors, so that if they slow down your shipments, you can go, okay, well, slow down my shipment, that's fine. That's the process how you manage your cash conversion cycle to minimize this, and maximize that. Here's Unilights. Unilight's a mess. We talked about Unilight over and over again in this class because Unilight's a mess. And we identified this, if you recall, when we were looking at Unilight back in chapter 2, back in chapter 3, back in chapter 4, and we were going, okay, where's there a problem? We identified this as a problem. We said, for Lord's sake, it's taken them forever to collect the receivables. Because we calculated day sales outstanding. We said, this is silly. It's taken them a long time. When you look at their payables deferral period, 8.8 days, that's kind of silly. Of course, maybe their vendors have said, this is kind of silly, so we're putting you on COD, cash on delivery, so when we deliver the stuff, you got to pay us in cash, otherwise we ain't letting it off the truck. So you want this to be closer to 30. And then you've got 79 days to turn the inventory into a sale. And you've got 43.2 days to collect the sale cash and have it come in or collect the sale or sell it and collect it. And we had talked about the fact that, for those of you who are marketing folks, that there's probably some product problems in here. We had looked at going, okay, are they having a problem? One, they're having a problem getting stuff sold. And then if you recall, they're having a problem getting the inventory. Their inventory is relatively high and getting old. And they're having a slow time getting paid by the retailers that they're selling to. So we had kind of made some hypotheses that, potentially they've got some product problems. which are underlying some of these issues. So if you're looking at this and you walk into Unilite as the new whatever you are, director of marketing, director of accounting, finance manager, etc., what would you do? What would be some of your suggestions to try and make this a heck of a lot shorter than 113.4 days? Speak up.
179.
How would you do that?
Well, that's just how long it takes you to sell it.
That's how long it takes you from the day the inventory shows up to turn it into a sale.
And how long does it take, like, to make it to a thing?
Well,
That is.
That all just combined into it. So
that's all combined within. So
I don't know if
Speed
they're
up
taking a long
production.
time to make it and it's sitting, or just take 70 days and they're having 9 days to sell it.
So that's going to be, when you're looking at this, you're going to come up with hypotheses, and that's a hypothesis. So we don't know, because we're not sitting at Unilite understanding, okay, does it really take 70 days to work its way down the assembly line?
Speed up production.
Or is it take 7 days to get through the assembly line, and it's sitting in the warehouse for 72 days in order to be shipped? So you've got areas where you're going to be able to explore. There's a couple things. If I were walking in, the first thing I do is go, why is this 8.8 days? The fastest thing to fix
Wait, okay.
is when to pay. You control that. You don't have to redo your assembly line. You don't take this from 8.8, 9 days out to 30 days, which buys you 21 days, which has now dropped 21 days off of that. You're going to have trouble finding 21 days anywhere else. It's going to be tough to find 21 days here. You can probably find 21 days on the payable side. Where we tend to focus naturally, because we're optimists, is we tend to focus on this piece of the cash conversion cycle. We tend to focus on how do we improve our operations? How do we collect better? The fastest way to correct your cash conversion is to pay later. Look at this first and go, okay, am I paying too quickly? Can I slow that down? Here at the university, I can tell you that the first thing I did when I showed up 2 years ago, almost to the day today, was said, okay, how do I manage cash through the summer? I slow down payables. Now I build $2 million. Okay, that solves that problem. I don't have to worry about lines of credit and other things. What else can you do?
Reduce the amount of inventory they have on hand.
Reduce the amount of inventory they have on hand. Recall that this is driven by average inventory turnover. So as I had talked about, if you take that inventory number and you drop it, that speeds us up. So is there a way for you to cut the amount of inventory that's sitting on the floor and go to closer to just in time? Because if you're closer to a just in time inventory, which means you order as you need it, it's delivered as you need it, you produce as you need it, and you don't have a bunch of excess waiting to go, sitting on the floor waiting for you're going to be able to cut that number down considerably. A lot of times that requires a lot of changes with your vendor, a lot of changes in your operation, how you order, and we're going to talk economic order quantity on Wednesday, I think. But there's more changes to your operation that need to happen to do just-in-time inventory. However, you can control this almost unilaterally. What's the one we haven't talked about?
Receivable.
How would you address receivables? Yeah, pick up the phone and start making phone calls. And if they're not gonna pay, identify those folks who aren't likely to pay, and don't ship them any more stuff. Cut them off. If you've got a credit risk, cut off your credit risk. If it's ridiculous, you're not going to get paid anyway. You don't go, well, I got sales. And your sales folks, and those of you who are marketing majors or intend to be salespeople, by the way, a lot of times your incentive compensation plan, your commission will have a clawback if folks don't pay. So you want to make sure that your clients are going to pay, because otherwise your commission is going to get clawed back from you. And if you don't have one of those, you've got every incentive in the world. And by the way, if you're a sales manager, your sales folks will have every incentive in the world to push stuff out, not worry about how it gets paid, because that's not part of their commission structure. You want to make sure it is. And if it's not, you want to make sure that you have good credit underwriting to make sure that you're not shipping to folks who are not creditworthy. So you start picking up the phone, you make phone calls, you cut off those folks that aren't likely to pay. And the last thing that you would do is for those that are kind of slow, but they're reliable, add interest and try and collect it. create an incentive for them to pay, just like you would. If you were sitting at home and someone started adding interest to your bills, you're like, okay, I'm gonna get rid of that one, because these other ones aren't. Start adding interest, so that way it incentivizes them to get the payment. Any questions on this stuff?
No.
Okay, I will see you all Wednesday. Thanks much.